Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
UBS posts its first quarterly loss in almost 6 years as the ongoing integration of Credit Suisse drags on performance. But shares rally as client inflows progress in meeting the cost-saving goals. Fresh doubts emerge about whether the Fed has finished tightening. Neil Kashkari says the fight against inflation isn't yet done. And Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite the third quarter net income dropping by almost a quarter. Good morning. You were supposed to be done with the Fed, hiking. But the bottom line is Neil Kashkari went whoosh. He just utterly emaciated the bull scenario because he'd far rather over-tighten than perhaps do a little bit less. So you've got a small reaction in equities this morning, down 0.25%. But the SLOOS report, Danny will pick this up in a moment, there's a tightening of consumer credit. The consumer, remember them? They spend until the last moment in the United States of America. Nasdaq down by 0.25%. Again, we're going to get more earnings coming along the slate today. Russell 2000, which is the belly, the very belly of America. There are profit warnings galore. Danny pointed out this morning there's more of a debt cliff edge in the Russell 2000, and you've had 500 days without hitting a new record high. Couple of stocks to watch for you. UBS, we'll talk to Guy Johnson in just a moment. It's up. They're doing the classic Monty, front-loading the costs, front-loading the restructuring. Know your pain, know your trade. Watches of Switzerland. I don't have a Rolex, but I have it on good authority. It's one of the pumping prices in Europe today, as the CEO tells us, the second-hand market. Maybe I can pick up a cheaper Rolex in the second-hand market if the cracks come to bear on Rolex. Watches of Switzerland, go on, up 8.5%. Danny Berger, good morning.
Good morning, Manus. I got bad news for you. The second-hand market is still too expensive for me to buy you a Christmas present there. I regret to inform. Like on the cross-asset picture, it is remarkable that equities held up yesterday, considering what this bond market has been doing, this absolute whiplash. We are having a rally this morning, down by about 30 basis points for your 10-year yield, matching what we saw last week. But yesterday, it was a move of more than 7 basis points higher for the 10-year, about 10 basis points for the front end, with no discernible news. Perhaps it was the supply question coming back into the fore with $24 billion worth of corporate debt pricing. That's something that this market needs to absorb. And today kicks off 3 days of auctions for this bond market. Aussie falling versus the dollar more than 1% after, yes, a hike from the RBA, but the minutes did not talk about the next hike. Disappointing the Aussie bulls. Finally, crude, that's down by about 2%. We're oscillating between the supply cuts coming from Saudi and Russia lifting this oil market and fears of demand in the case of today, downing it. We're below $80 a barrel when it comes to NYMEX crude. Now, Manus, speaking of demand, you mentioned the SLOOS, so I, of course, have to get into it for a radio listening audience. I do have a chart showing the demand for loans of corporations. Manus, it was tighter, but it wasn't as bad as we expected. We thought maybe it would be really bad considering Jay Powell was pretty dovish. Did he know something we didn't? Well, maybe not, because the results are that 30% of large cap firms reported weaker loan demand. That's better than last quarter. Last quarter, it was more than 50%. So sure, Manus, it's tighter, but there does seem to be some resilience in these figures.
Yeah, well, I mean, look, right up until now, the consumer has been the bulwark, hasn't it? And if you look at the other side of that SLOOS report, and we talked about this morning, you've got the corporate side, I've got the consumer side. And on the consumer side, it is tightening. There's a tightening of consumer credit, albeit perhaps at lower FICO scores, but they are less willing. The consumer is now less willing to use credit to burn their way through the spend. So as we come towards this dissipation of savings, we come towards those pandemic stimulus checks are long gone in the history books. It could be the cracks in the consumer that come to bear. Danny, let's talk about one of our top stories. It is UBS. The stock's rising this morning. This as the bank reports that expenses were lower than expected, despite the takeover of Credit Suisse dragging on its performance. Let's get to Zurich. Guy Johnson is on tour there, Guy. So it's the first quarterly loss in 6 years, Guy. What do you think the top line here is? Is it about net new money flowing into the newly constructed institution? Is that about confidence in the new organization? Guy, good morning.
Manus, good morning. It's about stabilisation. It's about the fact that progress is being made. It's about the fact that they're sticking to their 2026 targets. It's basically the fact that everything's on track, and I think that's what really the market was looking for here. Just a quick update on what is going on. This is the first full quarter that we've seen these two institutions together. These are unbelievably messy numbers that we're getting out. Basically, you've got UBS making a profit, Credit Suisse making a loss. One outweighs the other, but I think largely you can ignore that number. What is going on here is signs of stabilization in terms of clients. That's really important, and progress being made on the integration. It is going to be a difficult process. The key questions now going forward are, can they keep the people that they need? They're putting money aside to make that happen. What's happening in terms of people leaving the bank, the key people that they need leaving the bank? What's happening with the IT integration? Manus, Danny, pretty soon, the next set of numbers, the full year numbers, we're going to get the big update, the big strategy. These numbers here are kind of a bridge to that setup, and the fact that there are no nasty surprises is good news. That's why the market, I think, is doing what it's doing today.
Yeah, I mean, hey, I wouldn't mind being part of a group, Manus. I don't think, Manus, you'd mind being part of a group that got $50 million to be retained. I wish someone would spend that on me.
Yeah, $500 million. That's what we're spending to keep Guy Johnson on Bahnhofstrasse. It's retention. $500 million to keep the key capital. It's a pretty important part of the transition, though, Guy, isn't it?
It is absolutely critical, Manus, and you have seen defections. Is that process slowing down? Is that 500 million? That's not just for one person. That's for a group of people, but they're key people. Is that working? Is that having the effect? Are those defections starting to slow? And that's really critical. Relationship managers are the bread and butter of this business. The wealth management business is core to what they're trying to do next. They need to keep these people. Banks are ultimately about people. The IT systems are also critical as well. Remember, they're turning off effectively the Credit Suisse system and sticking with the UBS system. How's that process going? I think just the takeaway from today is really messy set of numbers. There are no comparisons you can make with any other quarter. So kind of the estimates I don't think are particularly useful. But the fact they're talking about an acceleration of the process, the fact that the process is on track, the fact that they're sticking to the 2026 guidance, that is kind of all the market really needed today. This is going to be a long, drawn-out process. There are going to be plenty of opportunities for slip-ups. This quarter has not delivered any major ones.
Hey, Guy, thank you very much for reporting for us there in Zurich on UBS, Guy Johnson. Now let's get to some of the other top stories that we're keeping track of on the terminal this morning. Manus, WeWork has filed for bankruptcy after struggling to recover from the pandemic and a failed public offering in 2019. The company listed both assets and liabilities of $10 to $50 billion in a Chapter 11 filing. WeWork underwent a sweeping debt restructuring earlier this year, but said in August there was substantial doubt over its ability to continue operations.
Well, Shein is said to be targeting a valuation of as much as $90 billion. That's the fast fashion giant laying the groundwork for an eventual US IPO. The timing of the share sale remains uncertain given the market volatility.
And Citadel founder Ken Griffin says global investors can't ignore China. Griffin spoke earlier at a finance summit in Hong Kong.
There's much more innovation outside of the United States relative to 50 years ago. This morning I was with one of the prominent Chinese business leaders. The management teams in China are extraordinarily capable. They produce extremely competitive products on the global stage. They lead in many areas that are important to the world: solar, EVs. These are really important competitive advantages that exist in China. Companies, great management teams, great products. If you're a global investor, you've got to be watching and investing here in China.
A big call there, but then they are all on the ground in Hong Kong. So you would expect a pretty robust message there. Let's turn back to the markets because the latest stock market rally running out of a little bit of puff alongside the hopes of a speedy Fed rate cut. Minneapolis Fed president told the Wall Street Journal that he's not convinced that rate hikes are over, showing concerns about inflation ticking back up again. For more, let's get to our cross-asset strategist, Ven Ram. Last week, we had Nat Alliance telling Danny and I the Fed was done, done, done. And here is Neil Kashkari killing the bulls softly. Good morning. Good afternoon.
Good morning, Manus. He's saying done, not done, not done, not done. And that message is what is feeding through to the markets, right? I mean, I don't think that the Fed is in any mindset to raise rates anytime soon, but I think what they do not want is premature positioning for rate cuts. When the Fed came out with what was seen as a very dovish statement last week, the markets interpreted the message as saying, does the Fed know what we don't know, which is, and therefore does it mean a very weak loan officer survey? And that's not what we saw from the survey. We saw that credit demand is still resilient. Of course, the economy is losing momentum, but it's not keeling over just yet. And that means that it's not in the Fed's interest to send yields lower. And that's the message we are getting from Kashkari. And we are seeing nominal yields much higher in tow.
If you look at another major central bank, though, then the RBA, their decision today to hike rates. But the message from them and the reason that Aussie is weakening so much versus the dollar is that bar to hike again seems higher. Despite what Kashkari says, is that not the message from global central banks right now, that if the data is starting to weaken, if they're going to hike again, that bar is really high?
Well, I doubt that reasoning, Danny, for the simple reason, we had RBA standing pat from June, and suddenly they've come out and started raising rates again. Of course, their statement was regarded as dovish today because they said whether they would need to raise rates from going forward. But then if you look at the rest of the statement that they had, it was pretty hawkish. They are saying that inflation is proving to be a lot more elevated than they expected. It's proving to be a lot more persistent than they expected. And they're expecting the CPI, headline CPI, to average 3% 2 years out. So they're essentially saying for 2 years, we are going to miss the inflation target. That doesn't strike me as dovish at all. So we need to be prepared for the markets, for central banks, the major developed markets, central banks to come out and raise rates if necessary. It's not done and dusted yet.
OK, we can revisit Danny's favorite word, pernicious. Persistent and
it
pernicious.
Is my favorite word.
It is. She does a lot of things. She helps me with a lot of words. She finds the words. I just grab them and I go, that's the word of the day. Ben, thank you very much.
I'm the vocab book.
Yes, she is. Excel spreadsheets and vocabulary. She'll be helping my diction next. Bloomberg's Ben Ram in Dubai on the markets. Danny, let's stack up what we got for the day. Minneapolis Fed President Neel Kashkari joins the Bloomberg surveillance team at 7:30 a.m. Let's see what he means in terms of his rhetoric.
But first up next on Brief, we're going to be speaking with Emmanuel Cau, head of European equity strategy at Barclays. Manus.
Stay tuned for the Bloomberg New Economy Forum. It gets underway in Singapore. This year's theme is embracing instability. The interviews you don't want to miss. After his numbers, the UBS CEO, Sergio Motti, takes to the platform along with a host of other names in Singapore at the New Economy Forum right here.
Right now, it looks like you can get equity-type returns from credit. A little below 10 for what we call liquid credit, stuff that's tradable every day, and well above 10, perhaps, for private credit, which is not tradable. The point is that, 21 months ago, today high-yield bonds yield in the 9s. 21 months ago, they were in the 4s. When they're in the 9s, you can invest in them with high expectations, competitive with equities, and more than sufficient to meet most organizations' needs.
Howard Marks of Oak Tree Capital discussing his outlook with Bloomberg on the sidelines of the HKMA Global Financial Leaders Investment Summit. Now, we're more than 80% into earnings season at the moment. It feels a bit like a choose-your-own-adventure. The market, for its point, has decided in large part to concentrate on some of the bad results. But I want to show you what sales beats have done. Less than half of companies that have reported in the S&P have beat revenue estimates for the third quarter. That's the lowest share since 2019. So is the era of unbridled demand from the consumer over? Or is there something else we should be concentrating on earnings? Let's get to our guest. Joining us now to discuss is Emmanuel Cau, head of European equity strategy at Barclays. Emmanuel, am I right to maybe look at some of this weakened demand coming from earnings, or do you see a different bright spot that makes sense to have the mood music be for this quarter?
Good morning, Danny. Well, I think we've clearly seen some sign of moderating demand in US and Europe. So as you said, that was the lowest number of beats we had in 2 or 3 years. And the mentions by companies of weaker demand, weaker economy are rising quite significantly. So there is no doubt that growth is slowing, and we are seeing that in much weaker top-line delivery. Now, I think the bright spot may be that margins are holding up, right? So top-line has basically come down, has normalized, but so far we are seeing the bulk of the corporates able to maintain fairly high margin. I suspect pricing must be offsetting some of the volume weakness we are seeing as well. So earnings have been beating estimate, less than before, but earnings are still basically delivering and growing, even though top line seems to be pointing to softer demand ahead.
Well, let's see how that top line continues. Emmanuel, good morning. It's good to see you. I like how you encapsulate the mood music. I want to understand your perception of risk. Last week was one of the best weeks in stocks that we had of 2023. But I look at what you say. We are bruised but not broken. The mood has turned decidedly risk off, with surging real rates, a higher dollar, mixed earnings, and a messy geopolitics hurting risk assets. But the sell-off in stocks is somewhat ahead of the moves in credit and earnings. However, the technicals are closer to oversold than overbought. So we're bruised but not broken. Does this mean we're putting in some kind of a base level maybe earlier in the US than we are in Europe?
Yeah, Manny, I think, look, you had a combination of risk-off event that, put together, hurt the market and, took market down pretty much 10% from the summer highs. And, we see a lot of, we saw some sign of capitulation, a lot of negativity in the markets. And, to some extent, our view and what you mentioned was written like a week ago before the big rally in the market. But our view was, look, it might not take much for the market to form a trading bottom. And I think the first condition for stock to stabilize is some relief on the rate side. We need to see some stability in rates, I think, for the equity market to find the floor. And look, we do believe that peak rates are in sight. We don't think we are completely done with central banks. We think the Fed might hike one more time in January, for example. The data dependency means that it's going to be very hard to get some insights from central banks for good. But, broadly speaking, we've seen rates going from 0 to 5% in the US. Most of the central banks are done with hiking rate, and that might come with a bit more stability in rates, hence help equities to form a bottom.
I'd assume, though, it'll take a while to really say, OK, we're stable now. We've gotten to that point because we thought we've been there before. I mean, yesterday we have someone like Kashkari coming out and saying we need to do more work. I'd rather over-tighten than under-tighten. So what happens in the meantime as we get glimmers of hope, false or not, like we did last week, that we have reached the end of the cycle? Is it just volatility from here on out?
Yeah, I think it's going to be volatility. And again, the point of being data dependent, it means central banks cannot really give some precise forward guidance from here. So, it's going to be a bit of a guess, game for the market. I mean, look, you had a significant easing in financial condition last week. Dollar was down, rates went down, equities went up. I'm not sure this is what the Fed wants. And the market is now pricing in pretty much 4 cuts by the Fed starting in May. And there is no way the Fed will accept that. So I would expect a bit of pushback on this, repricing of lower rate by the market. You have a lot of Fed speak this week. So I would expect maybe, rates volatility to resume and, that to be a bit of credit check for the market. But broadly speaking, I think we are swapping, rates or rising rates for slowing growth. And as we know, on 6-12 months horizon, if growth is slowing, I don't think rates will be the number one concern for the market.
Right.
Yeah, but we still have quasi-QE because if you look at what the Treasury's actually got to issue to pay, if you look at the amount of bonds they've got to issue just to pay the interest on the debt. So it's a battle royal between the Treasury and the Fed. But I'll leave you with that thought. Thanks for coming in. Hopefully the bottom is in. Emmanuel Cau, his thoughts from Barclays this morning on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London with Manus Cranny in New York. Manus, a few hours ago, we got the Saudi Aramco earnings, of course, the world's biggest crude exporter. two different threads here. One, net income did drop 23%, but at the same time, they've held on to this chunky $29 billion dividend.
Yeah, and the reason why that's so important, Danny, I mean, by the way, this is not a hugely owned stock because so very little of it was IPO. There's lots of chatter that the Saudis may go for another IPO, but it is one of the world's biggest crude exporters. The upstream business, Danny, including gas and oil output, that dropped by 23%. But of course, you know, they've cut, Saudi Arabia has unilaterally cut the amount of oil they're putting out onto the market, but it's all about the futuristic projects for Mohammed bin Salman. The more Aramco produces and money and dividends goes into the PIF, goes into the mega projects. Danny.
Yeah, you know, buying the Neymars, the Ronaldos of the world. You could probably afford a lot of Rolexes with that. At least someone out there apparently is going to be buying a lot of Rolexes. Manus, there was also Watches of Switzerland earnings. How's this for demand? They said that by 2028, they will double sales and double profit. Of course, the majority of what Watches of Switzerland sells are Rolexes.
Yeah, I mean, look, there was a monster rally, wasn't there? There was a supply shortage. Every time I went through Dubai Airport, I'd do a little video of the Rolex stand, and it was empty. It was like a barren desert of Rolexes.
Tragedy.
It was tragedy in itself. I don't wear a Rolex myself, but I'll leave you with that thought. I'm open to Thanksgiving gifts, Ms. Berger. Good morning.
Oof. Good luck with that.
Welcome back to Bloomberg Brief. I'm Emmanuel Cau in New York.
And I'm Danny Berger in London. Here's what you need to know. UBS posts its first quarterly loss in almost 6 years. The ongoing integration of Credit Suisse drags on performance, but shares rally as client inflows and progress in meeting cost-saving goals. Fresh doubts emerge whether the Fed has finished tightening. Neel Kashkari says the fight against inflation, it isn't over yet. And Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite third quarter net income dropping by almost a quarter. It's been some extreme whiplash in this bond market. We are rallying. 10-year yields are dropping by 5 basis points. That's what we saw all last week. But yesterday, Manus, it was a really unusual sell-off. Perhaps it was the supply of corporate debt, $24 billion of worth that came to market. We saw 10-year yields drop by about 7 basis point rise by 7 basis point front end did even worse. Now, in other central banks speak, RBA had their decision this morning. They hiked, but it's widely been regarded as a dovish hike. There was no outline for the next one to come. Aussie drops by about 1% versus the dollar. And finally, NYMEX crude. Talk about another volatile asset. Perhaps it's the demand concerns coming into the fore today, Manus. We had crude falling by more than 2% this morning. It's below $80 a barrel for WTI, despite the fact that it had been supply cuts that have really been holding up this market. And you and I were just talking about Saudi Aramco's earnings, which also underline this idea that, yes, Manus, they are continuing to hold on to that production supply cut.
Yep, certainly a lot of volatility there, but $64 billion worth more of supply is to come in 10s and 30-year bonds. So that indigestion of the bond market may indeed come to bear. Equities this morning are a little bit lighter. Were they broken? Were they pushed a little bit lower by Neel Kashkari, who will be with Bloomberg a little bit later on, saying he'd prefer to over-tighten than do too little. So that's about stacking it high. It's sort of like front-run yourself. Over-tighten, and then we can talk about policy error. So let's see what Kashkari really means by that. Stocks are just a little bit lighter on their feet. We've still got a host of people, Kalanovic, saying this is a knee-jerk reaction, the best week that we had of 2023 last week. When it comes to the NASDAQ, down by an eighth of 1%. Again, the momentum is really in the underbelly of the U.S. economy in the Russell 2000. We have gone 500 days without a record high on the Russell. The SLU's report, the lending officers report, I think Danny tells a lot. There's a tightening in the consumer credit, and they are less willing to rely on credit to give that support. A couple of stocks to keep an eye on. We're going to talk a little bit more about UBS. First loss since 2017, but the inflow of money is there. Stock is up 4%. And Watches of Switzerland, that second-hand market is going to be one of the prime drivers for Watches of Switzerland. Stock is up 10%. That is the leader on the Stock 600 this morning. Danny.
Manus, there is a picture that seems to be accumulating of weaker demand. You mentioned it in the SLUs when it comes to the consumer, but we're also speaking to Emmanuel Cau of Barclays about this, that companies are also reporting weaker demand. But the head-scratching thing is that margins are holding up. They're still having high prices. I mean, surely those two things can't continue to coexist forever on out.
No, well, there's this divergence, isn't there, between the corporate chart that you showed earlier. In other words, yes, lending is getting a bit tighter, things are getting a bit hotter, but it wasn't as bad as everybody had anticipated. Go back to Emmanuel Cau, and the whole point that he makes is this, which is for these markets to find stability, you're going to have to find stability in the rates market, and that is something that the market is still very unsure of. He said one more hike probably at the start of next year, but UBS is certainly in focus.
Yeah, I mean, those shares keep extending their gains, Manus. The bank had a lower than expected expenses overshadowed its first quarterly loss in almost 6 years. Let's talk about the details. Joining us now is Allison Williams of Bloomberg Intelligence, who's been, Allison, I'm not sure if you got up early or stayed up all night to follow these earnings, but we thank you for being here with us. It was a really messy quarter, and it's kind of difficult to come away with a clear narrative. What narrative did you come away with through these numbers of the integrated, now giant Swiss bank?
I think the number one thing that we saw was that steadying of the deposit inflows at UBS, but especially Credit Suisse. And actually, if you dig into the numbers a little bit, you saw that actually momentum accelerated in September. So we think that was the key positive. And it was in the wealth business. It was in specifically the wealth deposits. That was the key point of pressure that led to this deal. And also inflows into the Swiss unit, while UBS is also holding up well. So the rest of it is, as you said, very messy. So we did see about $2 billion of integration costs. We're going to see another $1 billion next quarter. We do think it's positive that they're accelerating the wind down in the non-core unit, managing down those risk-weighted assets. And I think the big news will come next quarter when we get the strategic plan, the 3-year plan.
Alison, good to see you this morning. I just want to focus a little bit more on the integration, because we hear incremental closing down the investment banking business, let's say in Spain. There's headcount reductions there. But this is very much his style. He's been through this reorganization process before. I get the sense that Motti and the team are front-loading the pain trade for investors. In other words, it's going to be $3 billion before the end of the year. The pain isn't done there. So he's actually front-loading a lot of the bad news. And from history, and having spoken to him a number of times, this is about get it out there, get it done, get the worst-case scenario in everybody's mind. And if I can do a little bit better than that, I will.
Yeah, and keep in mind, he is integrating two globally systemically important banks. That's something we've never seen before. It's certainly something we never expected to see. Imagine the complexity across these two institutions and really bringing them together. I think, the initial days are really just sorting it out. What is going to be core, what's going to be non-core, right? So we saw a lot being moved into the non-core unit. Credit Suisse had actually started to do this a little bit, and UBS really sort of accelerating that, and then talking about taking the opportunities to really offload what they can in that non-core business. And I think next quarter is going to be the same thing, right? It's going to be another very messy quarter, but as you said, the quicker you can be more aggressive and get in there and get things done, to clear the decks and make the way for the core business and really set the path in January or early February, whenever they report their fourth quarter results.
Alison, it's interesting because we're also in this period where we had talked about the talent war being over, but you look at banks that are having their moment in the headlines that need to hold on to talent. Goldman, to be specific, and in this case, UBS. $500 million of retention payments to key Credit Suisse staff. Can you put that into context of just how big of a figure that is in terms of contributing to overall costs for UBS?
Well, I think that certainly it does it contribute to the cost. As I said, there was $2 billion in integration costs alone in the quarter, so you can think about the $500 million in the context of that number. But really, that's about retaining revenue, right? And as we know, we talked a lot about assets, but there's also the core talent. And so the bank really does need to retain that talent, to think about not just the cost side of things, but the revenue side of things going forward. It's positive that we're seeing some of the client assets coming back, and we're seeing the wealth flows. But we also do want to make sure that the talent that is bringing in those flows managing those assets, as well as in the investment bank, where, by the way, M&A was one of the big positives we saw this quarter. M&A and the U.S. investment banking business are sort of two of the bright spots that UBS is hoping to leverage from Credit Suisse, and they are going to want to retain those bankers, especially in such a period of uncertainty.
Yeah, the investment bank was up 36% compared with last year, and it was fees on the deal making. Part of the entire thesis of why you ever owned UBS, let's say, relative to some of the other major players in Europe, was dividend. The price to book value of this bank is exceptional relative to its peers. How much of a re-rating do you think suppression there is because of the lack of dividend and the lack of buyback, which are two of the things that they're holding on to because they're integrating two systemically important banks? How important is buyback dividend narrative to the UBS 2024 narrative?
Well, I think it'll be important for them to keep paying out the dividend.
Yeah.
The buyback, however, and I think this is actually something that's working in their favor. During the pandemic, the most recent crisis, UBS had said, look, we're going to think about our payout more holistically, pay out a dividend, but move more towards buybacks where we can be more flexible. And that is paying off for them, right? Because they do have that added flexibility. And so there is going to be a pause for buybacks. But if you think about some of the U.S. peers where UBS generally will compare themselves, the U.S. peers are also holding off because they have Basel III Endgame. So a bit of a different story. But I would say from an investment perspective, their buyback, their total capital return is a bit held back, but that tends to be a common story.
Allison, just to wrap things up, you mentioned that it's going to be the next earnings report that we maybe figure out the bombshells, the big picture things that we want to know. What is going to be the message that this market needs to hear from Almaty in 3 months' time when they can give more details on the integration?
I think it's going to be tough, right? Because I think that this is a story that's going to require patience, and it's going to have to play out over time. I think what Almaty is going to have to do is to set targets that are both reasonable, that can be achieved, but also have enough upside enough to get investors interested. And I think to lay out a clear path, and the most important thing from there is going to be lay out a path that the bank knows that they can meet or beat, because it will be such a long journey.
Okay, Alison, thank you so much for being with us. Let's see what the grand plan is, and we will hear from Almaty later on this week at the New Economy Forum. Alison Williams, the Bloomberg Intelligence, burning the late-night oil. For a quick snapshot of what's going on with the banks this morning, UBS is actually up by 3.75%, the first quarterly loss in 6 years, but they are winning the hearts, the minds, and the money of the billionaires. There's a nice inflow there. Barclays up flat on the day, and HSBC just by 0.2%. Danny.
And it's turning back to the central banks, hopes of a speedy interest rate cuts were dampened yesterday by Neel Kashkari, saying it's too soon to declare victory on inflation. Now, Bloomberg also spoke exclusively to Oaktree Capital co-founder and co-chairman Howard Marks on how high he thinks rates will go.
I think that rates may go a little higher, but not terribly much higher, or not. There's substantial progress being made against inflation, and that's what matters. The economy is producing mixed signals, but at least inflation is well down from the peak, and things are performing well. So I would say that maybe a little higher or maybe not.
You've been known not to give your macro forecast,
right.
Although very recently you've made something similar, which is the thesis is that the sea change has come,
yes,
and that the next 10 years will be very different.
Very different from the last.
Yeah, and underscore the premise there. And what do I do with that information?
Well, if you came into this business since 1980, which covers almost everybody, you've only seen either declining interest rates or ultra-low interest rates. You have to go back into the 70s to have seen a different climate, which I fortunately did do. And I believe that this monotonic decline of interest rates is over. number one, there's not much room for a further decline. And number two, I think the Fed probably understands that it kept rates too low too long and that there was a negative consequence, certainly in terms of inflation. So, I think the important thing is that, and I said in my memo Sea Change, which was published in December, that I don't believe in forecasts, especially my own. But I'm willing to say that for the next decade, the Fed funds rate is more likely to be between 2 and 4 than between 0 and 2. That's as far as I can go. But and I only say that directionally to indicate my belief that the period of ultra low rates is over.
Our exclusive interview there with the Oak Tree Capital's Howard Marks. Coming up on the show, President Biden and Prime Minister Netanyahu discuss the possibility of a pause as the U.S. faces increasing outrage for holding back from calling for a ceasefire. That's next. This is Bloomberg.
Well, there'll be no ceasefire, general ceasefire in Gaza without the release of our hostages. As far as tactical little pauses, an hour here, an hour there, we've had them before. I suppose we'll check the circumstances in order to enable the goods, humanitarian goods to come in, or our hostages, individual hostages to leave. But I don't think there's going to be a general ceasefire.
Tactical little pauses, but no ceasefire. The Israeli Prime Minister Benjamin Netanyahu there. Joining us for the latest analysis is Bloomberg's Ros Matheson. Ros, good to have you with us. What more do we know about this call we understand between Netanyahu and President Biden? Do you think Netanyahu is now listening to a shift in tone from the White House? Good morning.
Thank you. Good morning. Yeah, we've seen a number of conversations now between the U.S. president and Netanyahu since the war broke out, and there has been potentially a shift in tone, not just from the U.S. president, but also from the U.S. Secretary of State, who was just recently in the region again, having a blizzard of meetings with Israel and other nations, and that's that escalating sort of statement of concern around the humanitarian situation in Gaza itself, and pressing Israel for these pauses in the fighting. I mean, you heard Netanyahu calling them tactical little pauses, so very, very brief indeed. We're only talking a matter of hours to allow perhaps some aid to get in for people to relocate further to the south. So this is not a comprehensive stop in the fighting or anything towards a ceasefire, but you are getting the US more publicly saying, they're highly concerned about the situation on the ground in Gaza.
And what is the latest on the ground in Gaza?
Well, certainly we've got Israel troops encircling Gaza City, which is the densely populated centre in the north, starting to push further into the city, and that's raising the prospect what we're going to get in the coming days and weeks is street-to-street, door-to-door combat between Hamas forces and Israeli soldiers. And in that environment, the fighting is going to be very, very slow. The casualty rate is probably going to go up, not just for the soldiers, but also for civilians who are still very much in that densely populated area. But again, the Israelis are saying they're there for weeks, if not months. This war is going to go on, and they are going bit by bit. But certainly they seem to be wanting to take over Gaza City and then essentially sever the north of Gaza from the south.
And, of course, the rhetoric around how to deal with this changes on a weekly basis. But in terms of deployment to the region, the Pentagon has announced that it's deployed the USS Florida attack submarine to the Persian Gulf. So tell us a little bit more about the significance of that submarine being in the region.
Well, that's right. It's actually a nuclear-powered but not nuclear-armed submarine. It carries cruise missiles, so it's less of an attack submarine than one that can send long-range missiles in if needed. But it comes against that backdrop of the broader build-up of US military forces in the region. The US has announced several times it's sending more troops into the Middle East as a whole. We know that its troops based in Iraq and Syria, for example, are becoming under regular attack, drone attack from places including Iran-backed forces in Syria and also in Yemen and so on. And so you're seeing bit by bit the possibility of the US being drawn in militarily to this conflict. That's something that the US clearly does not want to happen, but with such a strong military presence in the region, it does raise the possibility at some point that they do get pulled in.
Roz, thank you very much for joining us this morning. That is Bloomberg's Rosalind Matheson. Now, coming up, we're going to take a look at some of the market-moving events you need to know to get your day started. And a quick check on markets, as probably most of you have already started your day if you're watching Brief this morning. S&P 500 futures struggle to find their footing after just barely eking out a rally. Dollar remains strong, putting pressure on crude, down nearly 2% as 10-year rally after yesterday's sell-off. This is Bloomberg. Welcome back to Bloomberg Brief. Danny Berger in London, Manish Cranny in New York. Let's get you set up for your trading day with a look at what's ahead over the next 24 hours. It's a host of Fed speak that's going to be coming out throughout the day. Barr, Schmid, Waller, Williams, and Logan all on deck. Plus, don't miss our interview with Minneapolis Fed President Neel Kashkari. That's at 7:30 a.m. Eastern. And we'll get earnings from Uber before the market open, then eBay and Occidental Petroleum. Manis, all of that will hit after the market close.
Well, let's have a look at TripAdvisor because we've got their third quarter adjusted earnings per share. That beat estimates. They had a nice broad range of narrative for the market. The stock is up pre-market. At one juncture was up 11%. It is about restructuring. Various analysts have come out with their notes. They talk about a diversified earnings beat. There you go. TripAdvisor up 10.8%. Revenge tourism lives large, lives long, and prosper. KKR, you like a bit of KKR, don't you? Right?
I do. I also like traveling, too. So, yeah, sure. All of my favorite things. KKR, they're going to report earnings before the bell. Something that also might be helping them out here, Manis, just how Abu Dhabi's $1 trillion fund is going to be joining them for that Telecom Italia bid.
Do you know that in 6 years living in the Middle East, Adia never did an interview? They're one of the most discreet. There's only one person within Adia is allowed to sort of go out and speak publicly at various events. So it is probably one of the most closed information silos. It's a beautiful tower in Abu Dhabi. But of course, you know, there's one man who manages everything. Sheikh Tahnoon now has sort of a great deal of power over many things in Abu Dhabi. So that grid deal is going to be interesting. Adia and KKR.
Yeah, well, at least KKR speak to us. So, I mean, their offices aren't as pretty. So, I mean, there's that. Manis, we're also going to get some earnings before the bell today, too, though.
Indeed. We're going to get Uber. I'm using them regularly. Don't worry. I'm helping them. Apparently, I get 5 stars back. I give 5 stars to everybody. Occidental comes out after the market close as well. And, of course, we had those banging numbers from Saudi Aramco. But it is going to come down to supply of bonds. What level of indigestion will the bond market have? We're going to catch up with the Hoisington chief strategist, Lacey Hunt. That's a little bit later on. But there are your bond yields. As you said at the start of the show, it was a bit of a whiplash day, wasn't it, yesterday? But it's all about supply.
It was. And this is the remarkable thing about the rally last week. It's almost like we forgot about the threat of supply. Well, Manis, it came back into the fore yesterday, $24 billion worth of corporate bond issuance. And we have a pretty difficult issuance schedule for this week.
We've got $40 billion of 10s on Wednesdays, $24 billion of 30s on Thursdays. But there's T-bills tonight, I think you said. There's a little bit of bill auction.
Yeah, 3-year notes are going to be on offer today. I mean, bonds are rallying for today, but can it hold up with, as you say, the indigestion of supply?